Following the Islamic Revolution, Iran's banking system was transformed to be run on an Islamic interest-free basis. As of 2010, there were 7 large government-run commercial banks. As of March 2014, Iran's banking assets made up over a third of the estimated total of Islamic banking assets globally. They totaled 17,344 trillion rials, or $523 billion at the free market exchange rate, using central bank data, according to Reuters. Since 2001, the Iranian government has moved toward liberalizing the banking sector, although progress has been slow. In 1994, Bank Markazi authorized the creation of private credit institutions, and in 1998 authorized foreign banks to offer full banking services in Iran's free trade zones. The central bank sought to follow this with the recapitalization and partial privatization of the existing commercial banks, seeking to liberalize the sector and encourage the development of a more competitive and efficient industry. State-owned banks are considered by many to be poorly functioning as financial intermediaries. Extensive regulations are in place, including controls on rates of return and subsidized credit for specific regions. The banking sector in Iran is viewed as a potential hedge against the removal of subsidies, as the plan is not expected to have any direct impact on banks. As of 2008, demand for investment banking services was limited. The economy remains dominated by the state. Mergers and acquisitions are infrequent and tend to take place between state players, which do not require advice of an international standard. The capital markets are at an early stage of development. Privatization through the bourse has tended to involve the sale of state-owned enterprises to other state actors. There is also a lack of sizable independent private companies that could benefit from using the bourse to raise capital. As of 2009, there was no sizable corporate bond market. Electronic banking in Iran is developing rapidly. The needed $70 million initial capital for the opening of each electronic bank as approved by the Money and Credit Council compares with $200 million required to establish a private bank in the country. History. In 1960, the Central Bank of Iran was established as a banker for the government, with responsibility for issuing currency. In 1972, legislation further defined the CBI's functions as a central bank responsible for national monetary policy. In the 1960s and 1970s, the expansion of economic activity fueled by oil revenues increased Iran's financial resources, and subsequently the demand for banking services increased exponentially. By 1977, some 36 banks with 8,275 branches were in operation. Their top-line revenue has always been trade finance and letters of credit. After the revolution, the government nationalized domestic private banks and insurance companies. Bank law was changed under new interest-free Islamic banking regulations. The post-revolution reduction in economic activity and financial resources required banks to consolidate. By 1982, this consolidation, in conformity with the Banking Nationalization Act, had reduced the number of banks to 9 and the number of branches to 6,581. Subsequently, the system expanded gradually. The government began to privatize the banking sector in 2001 when licenses were issued to 2 new privately owned banks. In 2011, 7 state-owned and private Iranian banks were involved in a USD 2.8 billion embezzlement case, which involved forging documents to secure multi-billion-dollar loans and purchase state-owned companies. In 2014, Iranian authorities arrested 12 people for embezzlement of more than $4.5 billion from the Kerman branch of Teharat Bank from 2009 until their arrest in 2013. Types of financial institutions. As of 2011, about 80% of the country's wealth was deposited with state banks and the remaining 20% with private banks. Iran's financial institutions are banks, finance and credit institutions, Gazo-Larsenair funds, Islamic banking. In theory, Iranian banks use provisional interest-based transactions but retain the accounting standards of conventional banking. In 2009, Iranian banks account for about 40% of total assets of the world's top 100 Islamic banks. 3 of the leading 4 Islamic banks are based there. Bank Melli Iran, with assets of $45.5 billion, came first, followed by Saudi Arabia's Al Raja Bank, Bank Malate with $39.7 billion and Bank Saderat Iran with $39.3 billion. Iranian banks are still the predominant Islamic banking players, holding 7 out of the top 10 ranks and 12 of the 100, the Asian Banker Research Group reported. According to CIMB Group Holdings, Islamic finance is the fastest-growing segment of the global financial system, and sales of Islamic bonds may rise by 24% to $25 billion in 2010. Commercial banks are authorized to accept checking and savings deposits and term investment deposits, and they are allowed to use promotional methods to attract deposits. However, commercial banks are prohibited from investing in the production of luxury and non-essential consumer goods. Commercial banks also may engage in authorized banking operations with state-owned institutions, government-affiliated organizations, and public corporations. The funds received as commissions, fees, and returns constitute bank income and cannot be divided among depositors. Derivatives market. As of 2009, the Iranian oil bourse was a spot market for petrochemical products mainly, with plans to introduce Sharia-compliant futures contracts for crude oil and petrochemicals in the future. Trading takes place through licensed private brokers registered with the Securities and Exchange Organization of Iran, with help of Bahrain-based International Islamic Financial Market and New York-based International Swaps and Derivatives Association. Global standards for Islamic derivatives were set in 2010. The Hedging Master Agreement provides a structure under which institutions can trade derivatives such as profit rate and currency swaps, while the standards of the Bahrain-based Accounting and Auditing Organization for Islamic Financial Institutions are widely followed around the world. They are not enforced in Iran. Rates. As of 2010, the interest rate charged between banks is set by the government of Iran. In practice, because the banking system of the Islamic Republic is run on an Islamic interest-free basis, there are no interest rates per se but only provisional profit lending rates called Mobadala. Official provisional lending rate 12.0%, 11.5%, 12.0%. Free market rate is 24 to 25%. Deposit rates. As of 2010, private banks have acquired 11% of the whole money market in Iran. The range given covers the different interest rates offered by different banks. In 2010, for the first time in annual policies, the interest payable on bank deposits is similar for both state-owned and privately owned banks. For example, overnight deposits interest has been reduced from 12.5% last year to 9% this year. Similarly, 5-year term deposits will now earn 17.5% interest, as opposed to 19% the previous year. As of April 2014, the maximum interest rate for deposits of 90 days or less is set at 10%. The maximum rate for deposits of more than 1 year is set at 22%, and for other maturities the cap is set at 14 to 18%. In April 2015, the Central Bank of Iran reduced the maximum interest rate to 20%. Banking assets and liabilities. Bank Melli, Saderat and Sepa are Iran's 3 largest banks. Debts to the Central Bank of Iran. The total debt of 11 state-run banks to the Central Bank of Iran has exceeded $32 billion in 2009, showing a tenfold increase over the past 4 years. Bank Melli Iran, with nearly $9 billion, had the biggest debt, followed by Bank Sepah, Iran's oldest, with about $4.8 billion. Bank Muskan, Bank Keshavatsi, Bank of Industry and Mines and the Export Development Bank of Iran were next with the respective debts of $4.70, $4.10, $3.50 and $1.1 billion. Private sector banks had much lower debts. Bank Parson, the largest private-run bank, owed about $421 million to the central bank. In addition, the collective debt of state sector companies to the central bank has reached $25 billion. Overdue loans. According to unofficial figures, overdue loans have reached IR 175,000 BN, an increase of 75% over 3 years. Plan to inject about $13 billion to recapitalize the banking sector. 90 individuals have managed to secure collective facilities totaling $8 billion from Iranian banks, with previous $27 billion unpaid loans. In October 2009, Iran's General Inspection Office informed that Iranian banks have some $38 billion of delinquent loans, while they are only capitalized at $20 billion. Current average for late debts of Iran's state banks is over 15%, while the global standard is 3 to 5%. Non-performing loans peaked at 17% of total loans in 2013, representing almost 10% of non-oil gross domestic product. According to the IMF, summary of the assets and liabilities of the banking system in FY 2004, the balance sheet of the banking system showed that total assets and liabilities were $165 billion. An increase of 226% since 1976. In that year, bank assets were divided as follows: private debt 34%, government debt 16%, and foreign assets 22%. Liquidity funds accounted for more than 39% of total liabilities. The loan-to-deposit ratio was 100.8% in 2011. In 2014, non-performing loan ratio was reported to be around 18%. By 2017, the government is required to pay $12.5 billion to domestic banks to settle debts. A new report shows the assets of Iranian banks increased by a whopping 40% in 2014. In 2014, the total capital of Iranian banks reached the unprecedented figure of 13.3 quadrillion IRR, an increase of 3.8 quadrillion IRR over 2013. The deposits in Iranian banks for 2014 reached 5.9 quadrillion IRR and the loans paid to the public totaled 5 quadrillion IRR. The deposits indicate a growth of 34%, while the loans were up 22% compared to 2013. Excludes commercial banks branches abroad. As of March 2010, Bank Sadarat Iran, Bank Malat, Teharat Bank, and Refik Bank have been classified as private banks. As of September 2014, assets. The banks and financial institutions' total claims on the public sector amounted to 929 trillion Iranian rials, and total claims on the non-public sector amounted to 5,412 trillion Iranian rials. The ratio of the claims on the public sector to the claims on the non-public sector was 17.2% in September 2014, 15.6% 1 year before, and 13.4% 2 years before. This trend suggests that the government is using more bank resources than it was previously, and that banks are getting more dependent on the government's solvency. Liabilities. Deposits of the non-public sector amounted to 6,245 trillion Iranian rials, of which 78.4% is term deposits. This number was 74.5% 1 year before and 73% 2 years before. The trend is towards more term deposits and less sight deposits, which could be a result of the higher cost of money. the downward trend in the inflation rate, and the stability in the economy. The breakdown of term deposits shows that 44% of term deposits are short-term and the rest are long-term. In line with these changes, taking a look at the yield curve for the last 5 years shows that the right side of the curve has moved upward significantly, and the left side has become steeper, making long-term deposits more attractive. Banking reserves. The ratios of the bank's legal reserves in the central bank in 2009 were as follows: current deposit, 20%, interest-free loan deposit, 10%, short-term deposit, 17%, one-year deposit, 17%, 2- and 3-year deposit, 15%, 4-year deposit, 13%, 5-year deposit, 11%, other deposits, 20%. According to Article 14 of the Monetary and Banking Law of Iran, the CBI is authorized to determine reserve requirement ratio within 10 to 30% depending on banks' liabilities composition and field of activity. Sectoral allocation of banking facilities. In 2008, Iranian banks extended 70 trillion rials to quick-yield economic enterprises. According to Article 14 of the Monetary and Banking Law of Iran, the CBI can intervene in unsupervised monetary and banking affairs through limiting banks, specifying the mechanisms for use of funds and determining the ceiling of loans and credits in each sector. OTC market. Since 2009, Iran has been developing an over-the-counter market for bonds and equities called Faraburs. Its shareholders include the Tehran Stock Exchange Corporation, several banks, insurance companies and other financial institutions, and private and institutional shareholders. As of July 2011, Faraburs has a total market capitalization of $20 billion and a monthly volume of $2 billion. In 2010, 5.5% of the mobile telecommunication company of Iran shares were offered on the Iranian over-the-counter market, at a value of $396 million. This was the largest IPO to date in the Iranian OTC equity market. In 2011, Padais Petrochemical Co., the largest producer of urea and ammonia in the Middle East, Amir Kabir Petrochemical Co., Pasargad Bank, Yazd Alloy Steel Co., and Ravan Fanavar Co. went all public. Bond market. Participation papers. An important development for the Iranian capital markets was the opening of a fixed-income market for the first time in 2009, with the issuance of term deposit certificates. The only type of tradable Islamic bond in Iran is the participation paper. These are typically short-term bonds and have the same economic characteristics as fixed-rate conventional corporate bonds. For participation loans or musharaka, the interest rate charged by the banks is dependent on the profitability of the project for which financing is required. In April 2011, the government's plan was to limit the maximum rate at 20%. Profit and awards accrued to participation papers are tax-exempt. The central bank must obtain approval from the Majlis in order to issue participation papers. As of 2012, regulations for fixed-income instruments oblige that a market maker always buys back the papers from the sellers in the secondary market at par value, if there are no other buyers present. With participation papers, at the end of the project, the profit must be calculated and can then be distributed among the shareholders. During that time, dividends or interest can be paid. Around €9 billion worth of participation bonds in foreign currency and Iranian rials have been allocated for different projects in the oil ministry in 2010. €3 billion will be allocated to the South Pars gas field and the rest will go to oil field development projects. Bank Mellat's June 2010 offering of bonds worth €250 million overseas is considered the third stage of offering a total of €1 billion in bonds designed to help finance development of phases 15 to 18 of Iran's South Pars natural gas. The bond has a maturity of 3 years and an interest rate of 8%. New issues in July 2010 included $300 million of papers by the Tehran municipality and $100 million of participation papers by the Ministry of Energy. The vast majority of these participation papers pay coupon rates of 2 to 3% above bank rates. Also in July 2010, Iran and Shah Leasing Co. listed $8 million worth of participation papers. In August 2010, Iran sold about $500 million worth of bonds for the first development phase of the gas deposit. The 3-year bonds yield 16%. In November 2010, Iran will sell real bonds worth $2.3 billion to finance the second development phase of its South Pars gas field. The bonds will be sold through Bank Saderat Iran, Bank Melli Iran and Pars Oil and Gas Co. Previously, POGC had sold $1.5 billion worth of papers for the same purpose. These papers pay a coupon of 16% per annum and have a tenure of 4 years. In November 2010, Keshavatsi Bank listed $100 million of 1-year tradable certificate of deposit with an annual interest rate of 15%. Iran's national budget for 2012-13 has envisaged issuing €12.5 billion in bonds for financing domestic oil projects. For up-to-date amounts and list of issuing agencies, see CBI's annual review here. Sukuk is an Islamic fixed-income instrument, which looks similar to an asset-backed debt instrument. As of July 2011, and for the first time since the law was passed 3 years ago, Iranian companies such as Mayan Airlines and Saman Bank have respectively issued $30 million and $100 million worth of this type of bonds. Iran will also issue $15 billion in Sukuk bonds in 2012 to be invested in the domestic oil industry. Trading of Islamic bonds using the Salam format, a deferred sale contract, was disallowed by AAOIFI in 2007. But in Iran's debt market, Salam is a common form of Sukuk. List of Iranian banks. In 2010, the banker listed 13 Iranian banks in their top 1,000 banks in the world. In 2005, the Iranian banking system consisted of a central bank, 10 government-owned commercial and specialized banks, and 4 private commercial banks. In 2004, there were 13,952 commercial bank branches, 53 of which were foreign branches. Specialized banks had 2,663 branches. Commercial government-owned banks, specialized government-owned banks, non-government-owned banks, investment institutions presence abroad. A number of Iranian banks have established branches abroad, several of which have been subject to program of consolidation. Thus, in recent years, Bank Saderat has acquired the Iran Overseas Investment Bank and branches of Bank Melli and the Bank of Industry and Mines in London to form Saderat International. In addition, the London branches of Bank Tehran and Bank Malate merged to form Persia Bank.